Pavlik, Senior Portfolio Manager at Dakota Wealth Management, and Paul Meeks, Portfolio Manager at Independent Solutions Wealth Management. Guys, good afternoon. Bob, first with you. The variant seems to perhaps not, at least we don't have enough information on what this Omicron variant is doing yet. But even if it's not so bad, should we take this market action as perhaps a sign of what could come as far as revaluing certain stocks?
I don't think that the Omicron is going to be as big of an issue as potentially closing down the economy was last year or in 2020. So if you look at it from sort of that perspective, it's just another issue that you have to work through, just like we worked through the Delta variant. And I think as we move forward, the issues are going to be more surrounding the Federal Reserve and if they're actually moving the goalpost on us, speeding up the tapering, maybe delivering more interest rate increases than we were initially expected. That's what's going to cause stocks to reprice. Next year is going to be a good year, but it's going to be a difficult environment to start off with. People are going to be a little bit confused as to where to put their money. And then I think as we move throughout the year, we sort of get an interest rate increase under our belt, and we realize that the Fed's not going to be able to move on interest rates as much as they had hoped for, then I think you start to see some pretty good gains, and you probably see the low single or low double-digit returns for next year.
Okay. Now, Paul Meeks, I see some of these names that you like within the triple Q, Broadcom, NVIDIA, Alphabet in particular. Qualcomm too. Some of those names have been up quite a bit. I wonder if you have any thoughts about what's happened to growth stocks, particularly some growth stocks, over the past couple weeks. I'm thinking C3 AI, which had a beat and a raise, but is getting clobbered today. Elastic, another cloud-related name, had some good results. We got the CEO later this hour, but also down significantly. How do you factor in those kinds of moves, where you see bargains or what you're staying away from?
I've been covering the tech sector for a very long time, as you know, and of course I'm looking for sustainable, durable models. The problem with some of the particularly new age companies, the ones that came to the market in the last couple of years, some of that you've mentioned, they become so expensive, and the analysts that cover them and the portfolio managers that own them are requiring a diet of greater and greater growth and higher profitability. And I think some of these companies were really benefited from COVID, and now they're starting to see still pretty rapid growth, but a growth deceleration. And that is a suicide mission for some of these very highly priced stocks. So I like the ones that still have good fundamentals, good growth prospects, but they're not so egregiously valued. Okay.
And Bob, I guess a stock in tech that might fit that mold for you is Salesforce, but you also like consumer discretionary names like Nike, right?
Yeah, I think for somebody looking to build a sort of a core portfolio, you have to look to sort of the market leaders. Something like Nike, Chevron, Morgan Stanley. These are definitely market leaders that you're probably not going to get hit too hard with if the market continues to pull back a little bit. But if you're looking to add a little bit of alpha to your portfolio, you have to look outside the box. Salesforce is a leader in what they do, and they reported a very good quarter. It got hit hard. So here's an opportunity to add some alpha to that core portfolio, get a little more, more potential return in there.